widely expected the Bank of Canada will cut interest rates by 1/4 of a percentage point tomorrow morning. Let's bring in Robert Kavcic, senior economist, BMO Capital Markets. Great to see you, and thanks for joining us. So this has been your call for quite a while that they would cut by 1/4 of a point at this meeting.
Yeah, we've had this call for pretty much the whole year, going back 6 to 8 months or so, if I remember correctly. And our view all along, remember coming into the year, the market got pretty hopped up on expectations that the Bank of Canada and the Fed as well would be cutting rates pretty early and pretty often this year. And I think our view all along has been that, we haven't seen enough progress on inflation. And more importantly, the Bank of Canada was going to probably be a little bit extra cautious, leaning against this inflation pressure, just to make doubly sure, to make triply sure that they've seen enough progress on the inflation front before they actually go ahead and cut rates. So as of now, I think everything's kind of playing out in line with our forecast, and I think we have seen enough at this point for them to actually go ahead and make that move tomorrow.
But the underlying reality is we can't have our currency go down too much, so the bank can't cut willy-nilly if the Americans don't.
No, that's fair. And it's one reason why we think that this easing cycle is going to be pretty gradual. We do see 75 basis points of easing over the course of the year, but it's going to be pretty gradual. To that point, though, the market has effectively given the Bank of Canada this cut. It's almost fully priced in tomorrow. And I think if you look out through the rest of the year, I think there's about 20 or 25 basis points of extra Bank of Canada easing priced in already relative to the Fed. So the Bank of Canada can take a step or two ahead of the Fed and a little bit more aggressively than the Fed in terms of the amount of easing this year without really disturbing the currency market. But yeah, if we were to see something a lot more beyond that, up into the 75 to 100 basis point range in terms of how much they deviate, I think that's when you're going to really start to see the currency react in a negative way.
We're going to be hearing from Desjardins later on the show, and they're warning that we may not see a pickup in housing activity anytime soon, housing construction, even if they do cut rates. And you say, this is an interesting point you're making, that fixed mortgage rates are now much lower than variable. Finally, variable for years was the better bet. So what does that mean for a recovery in housing when they cut rates?
Well, so look, a lot of people out there in the real estate market have been kind of sitting on the sidelines waiting for the Bank of Canada to cut rates, thinking it's going to trigger another rebound in sales activity, another pickup in prices. And I just don't quite see it at this point. And one of the reasons is yes, fine, there'll be a psychological boost when the Bank of Canada presumably cut rates tomorrow or this summer, whenever that actually happens, in the sense that the market's going to now really see concrete evidence that the worst of this tightening cycle is over. We're kind of coming down the rate hike mountain. So it'll be a psychological boost from that. But the reality is that on the ground, if you're going to qualify for a mortgage, or if you're looking at it from an affordability perspective, the vast majority of Canadians are already working in that 3 to 5 year fixed mortgage space right now, because rates in that segment are a good 130, 150 basis points lower than variable rates. And in fact, if you look back over the last year of activity or so, I think barely 10% of mortgage activity in Canada has been in variable rate mortgages. So the bank, if they go ahead and cut rates 25 basis points tomorrow, from an affordability perspective out there in the market, it's really not going to do a whole lot, because most Canadians aren't using a variable rate product anyway. Mm-hmm. And to get real affordability back into the market, you're going to need a kind of a wholesale adjustment in the yield curve and what the bond market expects for interest rates going forward, in the sense that would pull 3 and 5 year fixed rates down. And that would include U.S. rate expectations as well, because our bond market is pretty tied to what's happening south of the border. So I just don't see the huge rebound that a lot of people are expecting on the real estate front.
Should Tim Macklem not just stand pat for now, because the economy is not doing that badly?
Well, the economy is not doing great either. I mean, we had 3 quarters through 2023 to end the year where we had barely any growth, and first quarter growth did pick up a little bit, but we were still stub potential. We were still, actually a full percentage point below what the Bank of Canada itself was expecting in the last NPR. So there is, from an output gap perspective, there is slack building in the economy. And I think the Bank of Canada looks at that in terms of it driving the inflation dynamic going forward when we look 12 or 18 months down the road. So from a growth perspective, there's some signs out there that things are not great and we are running below potential. And then the real key to all this, which kind of gives them the green light to go ahead and cut rates, is that if you look at core inflation over the last 3 and 6 months, most of those annualized rates for whatever measure you want to look at, and we know the bank looks at 4 or 5 of them, but they are all kind of in the 1.5% to 2.5% range, plus or minus. The point is, we are, from that perspective, we are effectively back to target for most core inflation measures over a shorter period of time. So I think there's evidence there.
Although I must admit, and of course it's not scientific, whenever I get the bill in a restaurant and I look to see the price of something, I'm frequently shocked. It feels like prices are still going up.
Well, there's a big difference between the inflation rate and the price level, right? So grocery price inflation might have melted away, but doesn't mean your shopping bag is getting any cheaper, because we've seen the price level actually ratchet up. So there's a big difference there, right? But the underlying inflation rate, of course, is what the Bank of Canada is focused on, and from that perspective, we're pretty much there.